But expectations, as we've been discussing, they're mounting for a 75 basis point rate hike amid rising inflation. And joining us now for more on this is Canaccord Genuity Chief Markets Strategist Tony Dwyer. Tony, good to have you here with us this morning. First and foremost, I mean, the environment that we find ourselves in right now, where the markets are trying to the best of their ability price in what the Fed may do and whether or not the Fed may actually tip us into a recession. Your thoughts on that?
Investors have no idea what the Fed's going to do, and I don't think the Fed has any idea what they're going to do. I mean, maybe they'll change it throughout this day. But remember, after the last Fed meeting at the press conference, Fed Chair Powell said that they're not actively considering a 75 basis point move. But then literally the next day, all the Fed governors are out talking about a 75 basis point move. So unless they wanted to talk to the media instead of the chairman, that seemed a little strange to me. So ultimately, it really comes down to what the market expects. And at this point, pretty much a 75 basis point hike is priced into it. And that really, ultimately, that sets the stage for, the potential for a bottom, not the bottom. And there is a differentiation we can talk about there. But, you've had 3 days in a row of 85% downside volume on the NYSE. The Fed meeting is tomorrow. Market, readjusted yesterday to the idea of a 75 basis point hike. So ultimately, if that's what you get, that kind of is built into it.
Hey, Tony, it's Julie. What's the effect of a 75 basis point rate hike? And I'm not talking about on psychology here for a moment. I'm talking about sort of logistically, structurally, mechanically. What does that do to market activity?
Well, let's talk about what it does to lending and credit. Mm-hmm. So a 75 basis point hike, which is a pretty good sized jump, changes all the short-term variable rate debt that's based on LIBOR or prime. So you're going to get a pretty good move. The ultimately, Julie, as you know, the market, what's been different this cycle that's been so intriguing, is that the Fed guided right away to where they thought the terminal rate would be. So you had a rate of change on the entire yield curve, meaning 2 years, 5 years, 10 years, 30 years. You had an immediate move to the terminal rate. So that was the fastest rate of change that I've ever seen. Even if you look at mortgage rates, I ran a screen this morning, it's more than double any 6-month rate of change that I can find in the history of the data series on Bloomberg. So it's really one of those times where the fixed side went there right away. Now the variable rate side is going to catch up. That affects all the short-term debt that moves with, again, as I said, LIBOR or prime. So we've gotten the fixed income, like the mortgage side of it, it's kind of in it, but that's not, because that's an increased interest expense.
Tony, I know you track a lot of indicators. Is there anything you're seeing that would suggest we are nearing some form of short-term bottom?
Yeah, I would say that those three things that I just suggested, or three things, that when you get 85% NYSE downside volume days, meaning for those that aren't familiar with that kind of statistic, it's when 85% of the volume traded on the New York Stock Exchange is to the downside. It was 98% yesterday. Those are extreme numbers. And again, it doesn't suggest the next tick's the low, but it does suggest that you've washed it out. It's not like the first day. That was 3 days in a row. When we look back at the last time that happened, it was in 2015 after the initial whoosh. You had 2 days that just ripped right back, went back down again, had another rip back up, chopped around, and then retested the low a couple of weeks later. So I think that is the kind of environment we're in. Our plan, guys, as you know, for this year, we expect a tumultuous year, and our game plan was to not sell into extreme whooshes. I would say that we're in an extreme whoosh. I would rather, if you're looking to cut back exposure because the money availability and the outlook isn't so great, Brian, I loved your 5 points. I would rather do it on a ramp, some kind of oversold bounce than into an extreme whoosh.
I did not love his 6 point.
Thanks, Tony. You're the best.
Which is that in the end, we're all dead. I did not appreciate that point.
I didn't like that
true,
one.
True though it may be. Tony,
so here's a great line that I use all the time in debates when people forget that I could be cautious too. I have been for the better part of the last year. But anyway, I used to do presentations and I would say that the sun is statistically going to blow up, but it's a bad trade, right? That's Brian's.
Tony gets it. He gets it. Thank you, Tony. Thank you so much.
So on balance, though, when you hear all of the cautious stuff that Soz was talking about, I mean, How are you feeling, Tony? For lack of a better question, like, how are you feeling? How are clients feeling? What does this period feel like as somebody who has been through this stuff before?
It never feels good. So I've changed my market opinion about 50 times in the last 10 minutes. So I never go by feeling. I think what hopefully differentiates me and our firm is we go by the data. And you look for the data. I've been doing this, as you said, Julie, for a while. It's since 1987. So I've seen May of 87. So I saw the best and then the worst. But what I can say is that I don't remember a major market correction that didn't end with the Fed becoming more dovish or signaling nearing the end of a higher interest rate regime. So we're in a situation where this whole thing, when you put aside all the feelings and all the silly stuff that we talk, not silly stuff, but the different things we talk about in the academic study, it comes down to money availability. If you're going to buy stuff, if you're going to do stuff, or if you're going to invest in stuff, you have to have money to do that. To your point or question earlier, Julie, the Fed is raising short-term interest rates. That is not helping variable rate debt. That has guided the long-term interest rates to a never before seen rate of change spike. That doesn't give you more money, and it doesn't help the housing market. So you're not going to get your money out of the housing markets by refinancing because your mortgage is so far below where it is today. You're not going to get your money out of your stock account unless you really kind of panic sell, and credit lines based on your stock account are largely shut down because of the declines. And anything you're earning is being offset by inflation. So when you put all the studies aside, it comes down to money availability. Do you have money? And that's what differentiates the bottom versus a bottom. A bottom comes from an extreme oversold condition or an extreme whoosh, technical term, as we said before. But the bottom, the real, even if it's higher, a higher price, you want to know that the Fed is not against you anymore.